This year, investors in one Morgan Stanley private credit fund asked for their money back. Less than half of it came. They asked to withdraw 11.6% of the fund. They were allowed 5. Everyone who asked received about 41% of what they'd requested. Nothing defaulted that quarter. Nothing broke. No manager panicked. The fund did exactly what its documents always said it could do. And that's the part I want you to sit with. This wasn't a failure. This was the product working as designed.
What you're doing is you're trading away a bit of liquidity for higher returns, and that's what's happened. And I think in the fullness of time, we will continue to see that. And by the way, that's the same trade-off institutional investors have made for a long period of time, and that's why they've allocated roughly a third of their assets.
But does retail understand the product then? We had the same conversation around BRE.
I think the individual investors and financial advisors, I think in most cases do.
Here's what these funds are sold on. High income, professionally managed, and a chance to ask for your money every 3 months. Underneath sit private loans that take years to exit and trade nowhere. For years, nobody tested that. Money was flowing in and nobody asked to leave. This year, people asked. And this may not stay inside the wealth channel. In March, the Labour Department proposed a rule making it easier for 401k fiduciaries to consider funds holding alternative assets. Only a proposal. But it opens a door onto a system with 90 million participants. Before we continue, if you want more videos that cut through the market hype and show you where the money is actually moving, subscribe, because that's exactly what this channel is built for. Alright, back to the real problem. If you're new here, my name is Martin. I don't work on Wall Street. I don't run a fund. I've got nothing to sell you. I sat through 2008 and lost most of what I had. Not because I picked badly, because when I decided to sell, I found out I couldn't. Nobody teaches you to check the exit before you need it. Here's the one idea that makes the rest make sense. Liquidity isn't a feature of an asset. It's a promise somebody makes about it. A share of Apple is liquid because thousands of strangers will buy it this afternoon at a published price. A private loan to a mid-sized company is not. Finding a buyer takes months. So when a fund holds the second and offers you the first, that gap has to live somewhere. It lives in a cap. Remember that, because it's the whole game. So what's inside? Software is one of the largest exposures in private credit. At one Morgan Stanley fund, around 23%. Morgan Stanley's analysts put the risk somewhere specific to heavily indebted borrowers, in categories artificial intelligence could commoditize, with debt coming due. They see defaults reaching 8%, against a historical average nearer 2%. I'm not telling you those loans go bad. I don't know. Investors didn't wait to find out either. Here's the mechanism almost nobody reads. If your request isn't fully met, the unpaid part doesn't carry forward. You submit again next quarter, and share the exit with whoever's asking then. So it isn't a queue. A queue would be better. In a queue, you keep your place. At that fund, more than half of this quarter's requests came from people who'd asked once already and been cut back. And it isn't one fund. Ares saw 14%, Blackstone 10%. Nobody's running. Pressure is building against a door that doesn't widen. Now I have to be straight with you, because I'm an analyst, not a cheerleader. The Federal Reserve looked at this in May and wasn't alarmed. For the 10 largest funds, 80% of the sector, cash and credit lines cover 3 straight quarters of redemptions at the cap. Risks to stability, they concluded, look manageable. And not every fund is straining. Goldman Sachs met every request in full. That's serious, and I won't spin it. But read the next sentence. These funds can decline redemptions altogether. The Fed offers that as reassurance, and for the system, it is. It prevents forced selling. Now read the same sentence as the person asking for their cash. So what am I actually doing? I'm not telling you what to do with your money. I've got nothing to sell you. First, before I buy anything that pays an income, I look for one line. Is there a cap on getting out? And what happens to the part they don't pay? Can they cap it? Does my place carry over? Not the yield, that line. Second, the receipt. Don't watch only how much a fund paid out. That's often limited by its own terms. Watch how much investors asked for. 5% is the stated width of the door. The request rate tells you the pressure against it. Every quarter, in the filings, free. So let me bring this home. Wall Street made loans that stay outstanding for years, then offered a quarterly window to ask for the money back. It offered a door. It never promised everyone would fit through. 11.6% asked, 5% got through. Everybody else had to ask again. Nothing broke. That's the point. The crowd is waiting to see whether the loans go bad. The patient investor already learned something more useful. How narrow the exit is before needing it. If you enjoyed this video, hit the like button, subscribe, and I'll see you in the next one.